Good afternoon. This is Todd Ensign with Capon and Krause, and I would like to welcome you to the continuing three-part webinar series sponsored by American Anglican Council on ministers' tax issues. And I am delighted to have Ashley Peabody, our tax senior with Capon and Krause, who will be helping me present the webinar today. Why don't we go ahead and start with a word of prayer. Father, thank you for this day. Thank you for those listening to the webinar today. I just ask that you would bless them and encourage them and strengthen them. And as we work through this webinar, we pray that you just help it to give us wisdom and good sense as we navigate these complicated areas of tax issues for ministers. And we'll just give you praise for what you're going to do. And it's in Jesus' name that we pray. Amen. Last October, we presented to you the basics of ministers' taxation. And in January, the webinar was on the latest legislative updates and how they affect ministers' tax returns. Both of those webinars can be viewed on the American Anglican website. And today we're going to talk about tax preparation tips for ministers. And when we get done with this presentation, it will be made available on the American Anglican website as well. Again, today we're going to talk about ministers' preparation tax tips. And one thing that we ultimately want to push for when you're preparing your personal income tax returns is just to be able to present all the documentation that you would need upon audit to verify your income and your deductions that are claimed on the Form 1040. And that's essentially what we're trying to get to. And many times, not many times, but once in a while, we will have clients who will take contribution deductions, for instance, on Schedule A. And the IRS may send them a letter that says they're denying the deduction on Schedule A for contributions until they provide the IRS with documentation that meets the IRS requirement for substantiation for that contribution, which would be the charitable receipt from the entity in the charitable entity in which they gave the money. And also, the IRS could come in and just simply audit an individual's return and document all the income and all the deductions that were claimed on the return to ensure that they were correct. And so you want to make sure that you are understanding the issues on the Form 1040 and understanding the documentation and substantiation requirements that you have to follow. And it can be very complex, especially with all the tax law changes that are going back and forth in Washington. And so you just need to be aware of what's going on. So as we step through today, what we want you to take away is that you have an understanding of these ministers' tax issues. And you may not understand all of them in depth, but at least you can have a good understanding that will help you ask questions when you're preparing your return and prompt you to understand those issues that you need to be aware of. Preparing an accurate return, the information we provide you will help you get there, and it'll also help you avoid common mistakes that the IRS sees when individuals file their personal income tax returns. So those are the things we want you to take away when we get done today. Ashley's going to start out and talk about a don't right now.
Our first tip for you is that you should not report Social Security taxes as an employee. And this is because ministers are treated differently than a typical employee of an organization. And this is called the dual tax status of ministers, because for income tax purposes, ministers are treated as employees, whereas for FICA tax purposes, ministers are treated as self-employed individuals. So Going along with that, another thing you should not do is have the church treat you as self-employed for income tax purposes if you are an employee. And to illustrate this point, we're going to give you an example of a lay employee W-2 and compare it to that of a minister. So first we have the lay employees W-2, where you can see their wages are up in box 1. Any federal income tax withheld that you elect will be over in box 2. And there will be Social Security wages and withholdings as well as Medicare wages and withholdings. And you can see over on the left the portions that the IRS will receive from both the employee and the employer, as well as those federal withholdings. In comparison, the minister W-2 has not a lot on it because all you will have is the wages up in box 1, any federal withholdings that you would elect in box 2, but the Social Security and Medicare wages, all those boxes will be 0. They will not apply for ministers. And it's very important to treat this accurately, and Todd is going to give us a real-life example of how this has affected a client in our firm.
Yeah, absolutely, Ashley. Many churches we find actually do this incorrectly, and it can really cause some very difficult tax situations, not only for the church but also for the minister employee. And as we're looking at this W-2, again, here's a typical lay employee. They have wages in box 1, and they're taxed on Social Security wages and Medicare wages and have the resulting withholding. And as we looked in the previous example, the minister does not have anything in box 3 or box 5, box 4 or box 6 as well on the related withholding. And what happens is many churches will treat a qualifying minister just like a lay employee. And so a minister's W-2 will show amounts in box 3 and box 5 and the resulting withholding, and the church will give the minister a housing allowance as well. So the minister is incorrectly having Social Security tax and Medicare tax withheld, and they take this W-2 along with a housing allowance, this incorrect W-2 along with the housing allowance, and complete their personal income tax return. Well, that just gives a number of things that can happen. The IRS can possibly reclass the individual as an employee. And what happens there is the housing allowance that's claimed on the employees utilized when preparing the individual's personal income tax return, the housing allowance will be not included in income up to certain limits. And if they reclass the minister as an employee, that housing allowance would be subject to income tax, and possible penalties and interest could result. Another possibility is the IRS could come in and classify that individual as self-employed, and the self-employment tax that the individual did not pay on the personal tax return could be assessed. Penalties and interest would be applied, and it would also have ramifications from the church's standpoint. They would actually probably get refunds back, but it just creates some difficult situations. And again, most ministers who are employed by a church receive a W-2 for income tax purposes, but are not subject to tax for SECA purposes or FICA purposes. And this is likely a non-issue for you, but just something that you can be aware of around the church industry.
Our next don't is that you should not file an exemption from SECA for the wrong reasons. And in filing Form 4361, there are a few requirements, and it's very important for you to read and understand the instructions to make sure that you are really filing it for the right reasons, and the IRS can't come back in later and say that something isn't right, because you really need to file it because you're opposed on the basis of religion. This is a contentious issue and just very important to understand and just very important that you make sure that you are filing it for the right reasons and not exempting yourself for the wrong reasons.
Let's talk about a due. Claiming adjustment for half of your self-employment tax on Form 1040. Many ministers don't do this and miss this. And as you know, a minister is subject to self-employment tax on their personal tax return. That means that the minister is paying both the employer and the employee portions on their personal tax return. But what many ministers don't realize is that there is a deduction permitted on page 1 of Form 1040 for about half of the amount of the SECA tax that's paid on the return. And let's look at Form 1040, page 1. This is the bottom of Form 1040. And we're just looking at the adjustments from gross income. These are actually deductions that you can take against the income that you include on the line items above line 23. And if you'll notice on line 27, it's the deductible part of self-employment tax and attached Schedule SE. Well, Schedule SE is where you compute the self-employment tax on your ministerial earnings, and once you have that tax, it goes on page 2 of the 1040. Well, up to about half of that tax you can deduct on line 27. And here is Schedule SE. It's the short form, but if you'll notice on lines 5 and 6, these are computations or steps that will take you through the computation of figuring your tax and the amount that is deductible on page 1 of the 1040. They're a little bit more complex right now with that 2% tax decrease for Social Security from 6.2 to 4.2%, but these step you through the process. Please be aware of these and make sure you're taking advantage of that deduction available to you on page 1 of your return.
Something else that you should do is report special occasion gifts as income. And these are gifts made to a minister that should be reported on the W-2 as taxable compensation. And this could include something from the church, from the general fund. It could be funded through members' contributions to the church. But it's just important to make sure to include it because it could be easily left out. Now, church members are allowed to make personal gifts of nominal value to ministers. For example, if you give them a birthday card or a little present, then that is going to be something that is non-taxable to the minister, but it is also non-deductible by the donor. So it's different than a contribution that you give to your church that you can then deduct later on your return. This is just something small that you wanted to give to the minister that wouldn't be deductible for you, but it also does not need to be included on the minister's return as income.
Let's talk about another don't. Don't exclude the housing allowance from SECA income when you're computing self-employment taxes. Very important that this is understood. And as you know, the housing allowance is non-taxable, subject to limitations, for federal income tax purposes, and it's not included on box 1 of the W-2, but for self-employment tax purposes on the personal return, the housing allowance is taxable. So when you go to Schedule SE and you report your W-2 earnings on Schedule SE, you need to add your housing allowance, your designated housing allowance to Schedule SE to compute your SECA tax. Now, the housing allowance is non-taxable to the extent that it's either the lowest of these three, the amount that you actually designate, the actual housing expenses that you incur during the year, or the fair rental value of your home as if it were fully furnished. And that includes utilities. Another limiting factor down at the bottom is a reasonable compensation, but generally that is not a limiting factor in most situations, but just be aware that that could be in some situations. So if you have a housing allowance of $40,000 and the fair rental value is $40,000 and you actually spend $20,000, then you can only exclude from income the $20,000 that you actually spent.
Two things to remember relating to this topic. The first is if you live in a church-owned rectory, it's important to recognize that it's treated two different ways depending on if you're looking at SECA income or income taxes. The fair rental value of that home, fully furnished including utilities, for SECA purposes, yes, this is taxable. You will need to include it, but for income tax purposes, it is not taxable and you would not need to include it. The second point is that an employer-provided home can be completely excluded if it meets three requirements. The first is that it is required by your employer. The second is that it's for the convenience of the employer. And third, if it's on church property. So if all three of those factors apply for you, then the home can be completely excluded from your return altogether.
So it sounds like, Ashley, we have about three different options. If you live in your own home or rent your own home, you have a housing allowance, and that's designated, and you have an amount that's already included in that's taxable for SECA income tax purposes. And then you have the option of if you have a church-provided parsonage that you live in, then if it's not required by your employer to live there for the convenience of the employer on church property, then you have to include the fair rental value of the home that you're living in provided by the church as SECA income and subject that to which will produce SECA tax. And then it's possible, again, that if you live in a church-provided parsonage and it's required by the employer that you live there for the convenience and on church property, you could actually exclude that from SECA income. So three different options and explained very well. Let's move to the next point. Is this is where you include it on Schedule SE. This is a long form in line 5A, and you put your W-2 income here. Is where you put your housing allowance, and the fair rental value of a home that you live in is all included here, and this is a form on which you compute the self-employment tax. One other thing that we want to step through is keeping adequate records to substantiate business expenses. We mentioned that at the onset of the webinar, and this is really a very big deal. And let's talk about accountable expense reimbursement arrangements or plans. These are, if you have a church, the accountable reimbursement plan must be documented in writing. Within the plan, there are timing requirements that you have to meet in order to turn in receipts so they can be reimbursed. If you don't meet those timing requirements, then the amounts that were forwarded to you would be included in income if there were amounts forwarded to you. But when you turn in, if an employee or a minister has business expenses, ordinary and necessary, and business expenses that they pay personally, and then they turn into the church to be reimbursed under this accountable plan, the minister has to turn in documentation of those business expenses, and you have to provide the amount of the expense, the date, the place, the business purposes, and if the receipts were over $75, you need to provide the receipts. If you turn in amounts for mileage, then you have to turn in some contemporaneous documentation as to the miles traveled, when they were traveled, the business purpose for their travel, and all this has to be provided to the employer. If you don't, then there are some possible ramifications. If the documentation is insufficient or the accountable plan is not in compliance with our IRS regulations, then you can get into some difficult situations where the amounts, if amounts are given to the minister in reimbursement and there's not sufficient documentation, then the amounts could be construed as income and included on a minister's W-2, and tax penalties could arise for both the employee and possibly for the employer in that situation. So very important to be careful about that. There are non-accountable plans, and ministers may receive allowances that if they are not, if documentation for expenses is not provided back to the church, then those allowances are taxable. One instance may be a car allowance given $200 per month to a minister to help defray expenses incurred when he's traveling for ministerial purposes in his own vehicle. Then that is taxable compensation. And if a minister does incur business expenses, ordinary and necessary business expenses that they pay personally, and they cannot turn those in for reimbursement to the church, then make sure that you get a signed document from the church that it will not reimburse those ordinary and necessary business expenses that the minister incurred. And also be aware that a minister, if they do have those unrelated business expenses, can do two things. They can use the gross amount of those unreimbursed expenses to reduce SECA income and therefore lessen your SECA tax, and you can also deduct those on Schedule A of your personal income tax return if you itemize your deduction. Now those expenses are subject to limitations, but you can deduct those on Form 2106. And but remember, if you do have unreimbursed expenses and are deducting them for SECA tax purposes and or on Schedule A of your personal tax return, make sure you have the documentation in place to substantiate those deductions. Failure to do that could really cause you some tax grief if the IRS did audit you and you cannot produce that documentation. So again, a warning here, if you have unreimbursed expenses, make sure that they cannot be reimbursed by the church if you turn them in. If they do, you really can't deduct them, and so you got to make sure that you get written documentation from the church to that effect. Please be aware on mileage. If you're claiming mileage on your personal tax return, unreimbursed mileage, then there are two different rates that you'll want to use this year. For mileage traveled from January 1st to June 30th, it'll be 51 cents per mile, and from July 1st to the end of the year, it's going to be 55.5 cents per mile. And please note that the rate for 2012 currently is at the 55.5 cents per mile.
Our next point is that you should not disregard the Deason rule. And you might be sitting here asking yourself, what rule? We're going to tell you about the Deason rule. And the Deason rule explains that if you, as a minister, part of your income is taxable and part of your income is not taxable. So the taxable portion would be your salary, what's on your W-2, and the non-taxable portion would be the housing allowance that you designated. Now, if you have business expenses for, say, books and supplies, you can't treat them all as deductible because your income is not fully taxable. So you're going to have to treat the business expenses in the same way, where a portion is deductible and a portion is non-deductible. So we're going to go through an example here to illustrate how this works.
Sorry, Ashley, we're having a little problem with the slide. There we go.
Okay. So, for example, if you have on your W-2 you have a salary of $40,000, you designated a housing allowance of $20,000 and had business expenses of $10,000. So about 2/3 of your income is taxable and 1/3 of your income is non-taxable. So your business expenses would be treated in the same manner, whereas 2/3 or 6,700 of the business expenses is going to be treated as deductible, and 3,300 or 1/3 is going to be treated as non-deductible. And again, just to explain a little bit more about the Deason rule, the Deason rule requires you to reduce your business expense deduction by the percentage of total compensation that is tax exempt. And it's important to note that this applies to both Schedule C and Form 2106. And if you want more guidance, the IRS has provided that in Pub 517 and also some audit guidelines they provided for ministers.
And we're going to just talk a little bit more about it. This is very, very important, and the Deason rule it can be misunderstood and it can be complex when you're preparing your income tax returns. And so we're just going to step through it a little bit more and solidify this with you in your mind. In step number 1, you divide your allowable housing allowance by the total ministerial income to get the non-taxable portion. You got to be very careful here because you may have a housing allowance of $20,000, and if you only spent $15,000, then the $15,000 is the amount that's going to be non-taxable, not the entire $20,000 that you designated. So you got to be careful with that. But you find out what your excludable housing allowance is, and then total, go to step 2, and once you figure out what your excludable housing allowance is and your total ministerial income is, then you get that percentage. You take that percentage and multiply it by your total unreimbursed ministerial business expenses, and that gives you the amount that is going to be non-deductible. So let's look at an example again, a salary of $40,000 on the W-2 for a minister, and they receive a housing allowance of $20,000 that's not included on the W-2. And let's say that minister during the year had $10,000 of books and supplies that they purchased that were in regard to the ministry and the earnings that they earn as an employee of the church. But the church did not reimburse those expenses, nor would they. So he has $10,000 of unreimbursed employee business expenses. Again, a housing allowance of $20,000, a salary of $40,000. Let's say the minister actually spent the entire $20,000 of the designated housing allowance, and the fair rental value of the housing of his house is actually $20,000 as well. So in the perfect world, they all match, and so $20,000 of the housing allowance is excluded from income. The total ministerial income for the minister is the $40,000 salary plus the $20,000 housing allowance. So you take the excluded amount of $20,000 divided by the total income of $60,000, and you get 33% of the total ministerial income is not included in income. So how do you deal with that? You take that 33% and you multiply it by the total unreimbursed employee business expenses of $10,000, and that means $3,300 of the $10,000 is non-deductible for income tax purposes. So we had $10,000 of total unrelated business expenses. $3,300 of that is non-deductible, so only $6,700 is deductible on Form 2106. That deduction on 2106 carries forward to Schedule A of your personal income tax return, and then that is included on Schedule A and subject to possible limitations, but that's the amount that would be deductible. Again, this is the Deason rule. Let's look at it one more time. Here's the taxable income on the W-2 of $40,000, a housing allowance of $20,000, and $10,000 of unreimbursed employee business expenses, a total of $60,000 ministerial income. $20,000 of that is 33%, and the W-2 takes up 67%. Allocate that to the total business expenses. Deductible is $6,700, non-deductible $3,300. This is the decent rule. Now let's look at Form 2106. That $6,700 would go down here, and you would have to give a schedule that shows the $10,000 subtracting the $3,300 to get to the $6,700. It carries again to your Schedule A of your personal tax return. So you have to make sure that you don't include the entire $10,000 on here and deduct it on Schedule A at $10,000. Again, the decent rule. And the decent rule also applies to Schedule C for ministerial income that you have. If it's non-ministerial income, it won't apply. But if you are an employee of a church and you get a W-2, and also on the side, let's say you have a music ministry and you get $10,000 a year from going around and ministering to churches, and you have some related expenses associated with the production of that $10,000 of income, then those expenses that will also apply to the decent rule, so only 33% of those expenses would be deductible. Now this income would also be included in ministerial income and add into the total ministerial compensation that would be taxable, so the percentage may change if you have a Schedule C. But keep that in mind. Again, this is the decent rule. Very important to know that it applies both to Schedule C expenses and Form 2106 expenses. But be aware, it does not apply to Schedule SE income. Now we said, again, that $10,000 of unreimbursed employee business expenses can be deducted against your ministerial income reported on Schedule SE, and it can reduce your SECA tax, and so that it does the percentage decent rule application does not apply to those expenses when deducting from Schedule SE income. And it's important to note also that if the decent rule applies to you when you're preparing your personal tax returns, you need to attach worksheets that show to your return that show those calculations, and the IRS provides those worksheets in the publication we mentioned earlier before the IRS. We want to leave you with some other thoughts to consider when you're filing your tax returns. Be aware that personal use of church-provided assets can produce taxable income to your W-2. For instance, if the church owns a vehicle, and that vehicle is provided to a minister to be used, and the minister uses it both for business and personal purposes, then documentation of either all the business miles or personal or both needs to be provided, and there are calculations that the church will have to go to report the personal use, the value of the personal use of that vehicle, church-provided vehicle, in compensation as taxable income. And that rule also applies, as we mentioned, to other employer-provided assets. It would not apply if the personal use is de minimis and not considered taxable. Also, reporting income associated with below market interest loans. Many churches will loan pastors money to help defray the costs for college, things like that, and many times these loans are provided interest-free. Well, the minister will need to report as taxable compensation the below market interest that's not reported, essentially the minister is paying on a loan, and if it's 0%, that means they aren't paying. If they had interest, they would be paying more to the church, and so really it's that amount that they would be paying if it was interest bearing that they're not, that is considered compensation. So you've got to watch that and be very careful not to underreport your income if this is the case. Only exempt yourself from Social Security as a minister if you are eligible. In some of our previous webinars, we talked, I believe on the first one, we talked about ministers that must meet IRS requirements to be a qualifying minister before the IRS. Just make sure you're meeting those, and I'd refer to our first webinar to get more information on that. But many people, ministers who may not qualify and meet the criteria before the IRS will treat themselves, have the church treat them as a minister when actually they aren't. And the ramifications from that could be very, very extensive for both the church and a minister. So be careful there. Be sure to claim a parsonage allowance, whether you live in your own home or rent your own home, or if you live in a home that's provided by the church, still claim a housing allowance for an estimated amount of expenses you would incur personally on house-related expenses. Make sure it's designated properly before the beginning of the year or when you become a qualifying minister. And again, our first webinar goes into a little bit more detail on that. Some other things that you might encounter and want to report as taxable income. If you have reimbursements, if a spouse accompanies you on a trip and your trip is for business purposes, but your spouse really is just going along as a convenience and a help to you and not really for business purposes, and the church pays for the spouse's travel, that's taxable compensation. So be careful in that area. If you have debt, if you had a loan that is for the church gave you and the church forgave the debt, you will likely have taxable compensation to report as well. Computational errors. Check your return for computational errors. That's a big thing that the IRS finds on many returns, especially if you're doing it by hand. Incorrect or missing Social Security numbers causes a lot of correspondence from the IRS to get things like that settled. Claiming a home office deduction. We find this to be a very common thing among ministers. They'll be claiming the housing-related expenses against their housing designated housing allowance, and that's a deduction from income. Well, the minister may have an office in the home that's used exclusively for business purposes and meets the criteria for a home office, and then they claim additional the home expenses again on the home office deduction that were already claimed against the housing allowance. And what happens is they're actually deducting these expenses twice. Well, only home mortgage interest and real estate tax can have that double deduction, but not the other expenses. So if you have a housing allowance and claim housing expenses, you cannot also claim the home office deduction against ministerial income. Excuse me. The other thing that you got to be aware of is home equity interest. Many ministers may have a mortgage on their home, plus they may have an equity line of credit, and they'll take the entire amount of that interest and utilize it against their housing allowance, but it may not all be able to be excluded. If you took out a $100,000 home equity line of credit and you utilized $20,000 of that to pay for a child's college education, and you took the remaining $80,000 and utilized it to maintain your home and make improvements to your home, then only 80% of that home equity interest would be able to be excluded against your housing allowance. And the other 20% would not, because it did not go to maintain or improve the home that you're living in. So be very careful in that area as well.
A few reminders that we want to leave you with today. The first is that this year's filing deadline is actually April 17th instead of April 15th. We get a couple extra days because the 15th falls on a weekend, and then it is Emancipation Day, which is observed in Washington, D.C. So we have until April 17th to file our returns, so you have a couple extra days if you need it. The second thing is to plan your estimates and withholding appropriately, whether your income will be more or less for the next year. You just don't want to be surprised at the end of the year that you owe a lot more tax than you expected, or that you withheld a lot more than you really needed to. Also, be aware of any changes in dependents and credits. For example, if you had a child during the last year, or if one of your children is now older and going to claim themselves on their return, you can't claim them as well. So you just need to make sure you recognize changes on that and the effect they'll have on the return, and changes in any credits. Todd went over all of the legislative changes that were talked about in the last webinar, so just be aware of those changes and how they will affect your return. And because there's always updates coming out and new things going on in the tax world, check our website. We have it listed here on the slide for you so that you can get to know our firm better, get to know any updates that are going on, and just stay in tune with what's going on in the tax world.
Yeah, and that's great information. And also, we didn't list it here, but I also want you to know that the IRS website at www.irs.gov is also a really neat place to find information for nonprofit organizations, churches, individual tax preparers, and ministers. And so check out the IRS website as well. And stay tuned for further webinars. We would really enjoy being able to present some more personal tax webinars. We're thinking definitely about doing something in the fall next year, maybe October, November, maybe after the election, to give you good information and tax planning ideas that may help you make any relevant changes you need to before the year end, and adopt any tax planning things that you need to with your personal return. So just keep updated and check the American Anglican website, and further information will be forthcoming for that. And it has really been my pleasure, and I thank Ashley for assisting me in presenting these webinars, and I'd really like to thank the American Anglican Council for this opportunity to present these webinars, and we'll look forward to further interaction. If you have questions or comments, here's our contact information, and you can ask us any questions you might like to. And let's see if there are any questions that anybody has sent to us. I don't see any questions at this point. And so I'd just like to thank you for the opportunity again to be with you today. And may the Lord bless you, and we'll look forward to conversing with you in the future. Thank you.